Do you need permanent life insurance in retirement? Do you even need life insurance at all? But what is specifically permanent life insurance? Where can it be advantageous, and where do you just need to watch out and say, I don't need that? That's what we're going to talk about on today's episode of Joe Knows Retirement, and we're going to have some fun with this one here today.
Joe knows taxes.
Joe knows the market.
Joe knows Social Security.
Joe knows income planning.
Joe knows pickleball? No.
This is Joe Knows Retirement.
So we often hear about permanent life insurance, and you got to be aware of this because you got to understand that some people out there are life insurance salespeople or maybe insurance salespeople where maybe they can only get compensated to offer you a product. And if that's the case, you need to be aware because they may sound and make this permanent life insurance sound incredible. And you've maybe some of your kids or grandkids are on TikTok and they've seen some videos of people talking about permanent life insurance and how it can be tax-free income and how advantageous it can be. And if you save in it now, compound interest is going to do great things moving forward. And well, some of that may be true, but for someone your age, 55 to 70 that are in or near retirement, life insurance can be definitely attractive in some areas. But for a lot of these people, what they're saying you should use it for, you just need to be aware because you may not need it for those purposes. And so some of the things that we see that maybe you don't need permanent life insurance at this point in your life is, one, you may not need the coverage, right? Your spouse may be good to go if you pass away because you've been what's called self-insuring up to this point. You've saved enough money that if you pass away, you don't need the life insurance. You have your investments. Your spouse will get the higher of the two Social Securities. You're going to be good to go moving forward. So if you find yourself as that Midwestern millionaire that we always talk about, that person who saved at least $1 million and they've done the right things and they're frugal and they're diligent savers, well, then for you may not necessarily need the life insurance. Now, don't take that as specific advice because if you like to spend, well, then you may need to make sure that that's covered or maybe you need to prepare for any events that come up. So life insurance still could make sense for you to cover that need, but you just have to evaluate. But a lot of our clients, they don't find themselves, we don't necessarily suggest that they need life insurance to make sure that that spouse is going to be good to go to not run out of money at this point in their life. They may already have enough money for that. The question now becomes of how do we do more advanced planning, and can life insurance be a good resource to help us with our planning from there moving forward? So that's one reason why you may not even look into life insurance, you may not need it. But another reason is, again, most of these people say you need it for tax-free income. And life insurance structured the right way certainly can be used for that. And we've suggested that in the past. For some people can make sense, but you got to understand how this works. Life insurance has cash value that grows over time, and you can take policy loans, which would be considered tax-free. So it is a wise opportunity, but the cost of insurance and life insurance can go up the older you get. And so you may not be seeing as much growth there because even though that cash value can grow over time, what is that cost of insurance? What are the fees that are eating up at your policy that are restricting that cash value to grow as fast as maybe it could in the stock market or in other investment vehicles? And so you have to weigh the pros and cons of that. Life insurance is not free necessarily is ultimately what we want to encourage you to look into. So not trying to say that it's not a good opportunity. I'm just saying for the most people that we work with, it's not something that we would necessarily be super excited about implementing for their situation. Maybe a Roth IRA could make more sense for them to get that tax-free income for them at that point. And also we have to understand that you have to be insurable to even talk about life insurance. So maybe you've had health events, maybe you're not expected to live as long. You may not be eligible for life insurance, which makes this opportunity not usable. But for those who have been healthy and those who have taken really good care of their health and haven't had any unfortunate events, you could actually potentially get life insurance to cost less because if you get a higher rating. So you may get a preferred plus rate or a super preferred rate depending on which insurance company you use, just for having great health. And that could allow you to get more coverage for a lower cost, which could potentially make this more advantageous for your planning moving forward. So just make sure you understand how health plays a part of this. The good news for you is if you're not sure if you'd be eligible for not, you can at least explore it before you commit to it. So you can, talk to these insurance companies and see, or work with an advisor who can get an understanding of your health situation, explore with all the insurance companies out there. There's more than one insurance company out there to see what they would offer you. What are their quotes? What are they going to come back at? And so you just want someone who's going to work on your behalf to make sure that they can help you decide, one, if you should do this, but two, what company should you go with? 3, what's your health? for how much you need and how's it going to work, right? And again, that's why I'd always suggest to not work with an insurance salesperson. If you do want to explore this further, work with a team, work with a comprehensive retirement planning team, someone who is a certified financial planner who understands the complexity of retirement planning, someone who understands how insurance plays a part into a financial plan, because there's some advisors out there that won't even talk about insurance. If you want life insurance, they can't help you with it. They have to send you to an insurance salesperson down the street or another advisor to get that done. And so we always recommend work with an advisor, a CFP, someone who is educated in this area, but also someone who is insurance licensed, so you don't have to go somewhere else. You have a team that you can trust to make sure they get it done all in one place. And that's what we call a family office approach, right? The collaborative approach to make sure you can get everything done in one place, but also to make sure they don't count out this opportunity. Again, life insurance is not for everyone, but for those people who it makes sense for what we're going to talk about here soon, you want to make sure you can explore that if that's going to be what you're looking for. So let's talk about where permanent life insurance could come into play. So let's say maybe your goal is to leave behind money tax-free to your beneficiaries. Well, you can do that one way through a Roth IRA. And so you can do Roth conversions and different strategies like that. And that's something that we are definitely, I would say, pro for those strategies. We agree with those strategies. But a life insurance is another way you can pass money along tax-free. So if you're ever thinking legacy planning, I want to leave money to my kids, I want to leave money to my spouse, I want to leave money to someone or something, then life insurance can start to be a consideration. Now, if your goal is to not leave money behind, again, it could be another reason why you don't look into life insurance, to go along with some of the other points we made earlier. But this is a way that you can basically think of it this way. You take one coin and you can turn it into potentially 3 coins when you pass away. So you can get all the growth on the money you put in tax-free. The analysis you have to say and do is, what is that ROI? What's the return on my investment over time? And is this an attractive opportunity? Don't only just factor in the ROI of what you put in and what it is, but also factor the after-tax ROI. Because remember, all that growth is technically tax-free versus if you were to put this money in a brokerage account, for example, where you would have to pay capital gains on that money potentially over time. There is a stepped up cost basis on the non-qualified account right now, so that could be advantageous to use, and maybe that's the reason you do that instead of the life insurance. But there's all these different things to look into, like we're saying. And also, some of these life insurance policies nowadays allow you to accelerate that death benefit to use for long-term care. And so if you'd like to make sure that you have the coverage in place that maybe we do need a long-term care, well, we can use up our life insurance for that benefit so that the money we put into it can be used in more than one way. And so it's going to give you a little bit more flexibility in planning, but also that benefit when you use it for long-term care is also tax-free, so it can help your planning to have that extra asset or that extra resource that you could go to maybe outside of your investments. Maybe the investments are down that year and you don't want to take it out. Okay, we can go to the life insurance. Or maybe that we have all our money or a lot of our money in tax deferred, and if we take a withdrawal from there, we're going to have to pay a large amount of taxes. Okay, well, if we take from the life insurance, that's going to be tax-free for long-term care if we have that ability to do that within the policy. So just something to look for as you're looking for policies is maybe to see if that opportunity applies for it and to see if that's going to be a good option for you. And here's another consideration of the life insurance. And again, you may not need the life insurance for coverage for your spouse, but here's a planning thing that we've done with people actually in real life when a spouse is predeceased, is you take that life insurance policy and now you can use that money to pay taxes on a Roth conversion after that spouse passes. Now, why would that be important? The reason why is because the widow's penalty, when one spouse passes, their taxes go from married filing jointly to single, which means they may have to pay nearly double the amount of taxes. Now, from a planning standpoint, if in the year that the spouse passes away, you still get to maintain a married filing jointly tax bracket. So if that spouse passed away in January, for that year, they still get married filing jointly. Even though they were single for 11 months, they still get married filing jointly. So we do need money to pay the taxes if we do want to do a larger Roth conversion and utilize the married filing jointly rates. And so having that money set aside to pay the taxes on that conversion, that can make a lot of sense, and allowing that have that liquid money to do and take advantage of that type of opportunity. And I think another point to consider here is diversification, right? I mean, I think we talked about this earlier, but not putting all your eggs in one basket. Life insurance is a tool that's maybe different than the stock market, maybe different than an annuity, which is also with an insurance company, maybe different than a treasury or a money market account or a CD. These are all different types of assets, if you want to call that, and that can help with your planning because we don't know which one will do better. Who's to say that the life insurance is the best option versus the stock market, right? If you pass away tomorrow, you're going to get a lot more growth in the life insurance than you are in the stock market. If you live for 40 years and you're 60 years old and the investments do 20% per year, I could probably tell you that's going to outperform that life insurance death benefit over time. So again, we don't know what the perfect vehicle is to put our money, and so that's why diversification can make sense. So I'm not saying this to tell you to do the life insurance. I'm telling you this to consider all of these options out there to make sure you're truly finding what are the best resources for you. Because with our clients, there's a majority of them that don't have life insurance. But in the right situations, as I'm explaining, it can make sense. So the key is just explore it and see where you sit with it. Now, a place where we do truly look to use life insurance is when it comes to estate planning for those with a higher net worth. And so if you find yourself with $5 million or more today, or maybe you have $1 million, $2 million or more, then this is something that I would expect for you to plan for over the upcoming years. So the reason why I threw out that $5 million and also that $1 to $2 million is because of what's called the estate tax. Now, the estate tax is only subject to those right now with a very high net worth. It's about $13 million per individual. Now, as we know, in 2026, that is going to be cut down in half, so there's going to be more people subject to this estate tax. And if you've been following legislation, they've talked about bringing that down. The current administration's talked about bringing that down to $3.5 million, which ultimately is going to impact more people. And if you go back in history, in 2001, the estate tax was subject to people who had over $1 million. And if you look back, I think it was 1997, if you had over $600,000, you had to pay a 50 or 40% tax on the estate tax, but anywhere between 40 to 50%. In addition to those numbers. So let's go to 2001, $1 million is the limit. If you had $3 million, that $2 million above, you'd have to pay nearly a 50% tax on it. You're having to pay 50% on $2 million of excess. That's going to be almost $1 million that goes to the government and not to your loved ones. And so that's why this estate tax can be so severe and why it's so important to plan for it. So where life insurance can come into play is, let's say you set it up today, you can utilize the today's exemption amount of a much higher amount, and you can put your life insurance in what's called an ILIT, an irrevocable life insurance trust. And so we do this with our clients who have $5 million or more currently to make sure we're utilizing that exemption, right? If they have $5 million and they're 60 years old, then they're going to accumulate and grow that wealth over time. It's going to keep growing. Even if they want to spend the money, it's going to be a hard time spending that amount of money with the way this account can grow over time. And so they're going to find themselves in that estate tax category is what we're expecting. So we want to utilize these high exemptions now. And by putting it in the ILIT, we're able to use up that exemption now so that when they do pass away, the amount of money in that ILIT is not subject to estate taxes. We basically avoided a 50% tax on that money there because we did some planning. Now, the negative is we can't touch this money. We can't access this money. It's an irrevocable life insurance trust. We're giving up ownership. So you don't want to do this with all your assets. And again, that's why I said it only makes sense for those with more assets, because you need to make sure you have enough for you while you're planning. But if there's a chunk that you're like, I'm never going to need this, I'd rather just get to the kids, this is a way you can do so, but also do so with a magnified amount of giving more to them, right? You put in 1 coin, you get 3 coins. This is a way you can do that. And not only have an estate tax free, but also federal tax free when you leave this money to them. And if you have that type of net worth, you're going to have a big federal estate tax. Having the ability to have that federally tax free is going to be very helpful as well. So again, you want to work with not only a financial planning team, but also their estate planning team to make sure that they're collaborating, to make sure this is done the right way, and also make sure you're maximizing that death benefit in that policy so you're going to leave the most behind is the goal. You can look at a joint payout to make sure you could potentially pay that higher, because again, you may want this to go to the kids or whoever after both spouses pass. So that's something you may want to consider there. And I said $1 to $2 million. And the reason I said that is because you may not need to look to set this up now. This is maybe only an opportunity for those 5 million or more in my mind. It could be different though. Maybe you're expecting an inheritance, or maybe you're expecting your investments to grow even more and you're younger. Then maybe you do start looking to use up some of the exemption now. But for those with less, be on the radar, because your wealth is going to continue to rise and that limit's only going to go down. And so there could become a point where you do hit that limit. Maybe it's 10 years, maybe it's 15 years, 20 years. We do know the government needs more revenue. We do know that this is a way they can get more revenue. We do know that they've been targeting the wealthy. And so if you have $1 million or more, you're in the top 10% and you could be considered wealthy. And these are the type of ways where life insurance can help save a lot of money on taxes. So definitely some more advanced planning that we're talking about there. But really what I want everyone to understand from this video is explore your options when you look at retirement planning. Don't count something out. Explore it, see pros and cons, and ultimately make that decision that's right for you. There's some people who watch this video that maybe life insurance makes a lot of sense for. There's others who watch this video where they could pass on it. They don't need it. Maybe you don't have as much saved up right now. You do have a pension, or maybe you have a higher Social Security, and you do have enough investments like we talked about self-insuring, where maybe you don't need to worry about the complexity of adding this type of opportunity to your financial plan. But the key is explore further. And if you like these types of videos, go ahead and subscribe to this channel here, and we'll show you some more other videos that you can watch here to stay engaged and making sure that you're planning the best retirement you can moving forward.